Welcome to Tesla Deep Dives. The topic today, the art of the risk take. Was Musk's "don't buy for safety" remark a marketing masterstroke or a litigation time bomb? Welcome to the art of the risk take, where we dissect the razor-thin line between market genius and corporate liability. Our focus today, Elon Musk's blunt advisory to potential buyers of the new Tesla Roadster. The core remark delivered on Peter Diamandis's Moonshots podcast was stark. If safety is your number one goal, don't buy the Roadster. This isn't a comment on a flaw, but a marketing pivot, with Musk clarifying that a buyer's primary goal, like those buying a Ferrari, is performance, not safety. This statement lands in a uniquely volatile context. On one hand, Tesla's mass-market vehicles, like the Model 3 and Model Y, consistently earn the highest 5-star safety ratings from bodies like NHTSA and Euro NCAP. On the other, the company faces a major liability cloud over its core growth driver, full self-driving, FSD. Critics argue Musk is providing direct evidence against the company's own safety score ethos. Furthermore, a late 2025 ruling by a California judge found Tesla guilty of deceptive marketing over its FSD claims, proving a legal vulnerability in its aggressive naming and promotion. Legal analysts specializing in product liability emphasize that this kind of comment, while for a niche vehicle, can reinforce the failure to warn claims against the company, especially given that 66% of consumers now demand Tesla be held legally responsible for FSD accidents. Proponents, particularly on X and enthusiast forums, see this as an honest disclaimer that heightens the vehicle's legendary status. They interpret it as a functional warning against the sheer physics of a car targeting 0 to 60 miles per hour in under 1 second. This risk-embracing strategy targets a hyper-niche clientele of adrenaline seekers, positioning the Roadster as the best of the last of the human-driven cars. Financial analysts report that the stock price does tend to fluctuate, reflecting investor unease following such controversial announcements. The negative narrative currently dominates broader market sentiment for the core business. The analyst consensus is that FSD's regulatory headwinds and declining consumer trust, with 35% of consumers less likely to buy due to FSD, make its safety reputation a liability to long-term brand value. The net effect is a high-reward, high-risk split. The masterstroke is limited to the ultra-high-end Roadster market, generating hype with low sales volume. The time bomb is tied to the multi-billion-dollar FSD division, facing concrete regulatory and legal action. The latter presents the more significant quantifiable risk. Investors must monitor two critical metrics. Firstly, the frequency and cost of NHTSA recalls tied to FSD software updates, as a rise indicates escalating regulatory pressure. Secondly, track the average cost of litigation settlements for autopilot-related accidents. A rising trend here confirms the time bomb is actively detonating and translating marketing risk to balance sheet liabilities. Let me know what's your thoughts and leave your comments. Thank you for joining us for this deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.